We are currently witnessing one of the most deceptive market structures that has formed in the last 18 months. While the price of Bitcoin has managed to reclaim the $60,000 mark, the underlying data suggests this recovery is built on a foundation of sand. Most retail investors are celebrating this bounce as the return of the bull market, but the on-chain metrics are screaming a warning that we are potentially walking into a sophisticated bull trap. The reality is that your capital is at significant risk if you do not understand the difference between spot-driven accumulation and leverage-driven speculation. Over the next few minutes, I'm going to deconstruct the specific liquidity pools and whale movements that suggest a final flush to the downside may still be on the cards. I will show you exactly why the $60,000 level is acting less like a support floor and more like a ceiling for distribution. Let us get into the weeds of what is actually happening behind the scenes of this price action. To understand the gravity of the current situation, we must first look at the volume profile associated with this recent move upward. When we see a genuine reversal from a significant correction, we typically look for a massive spike in spot buying volume that indicates conviction from long-term holders. However, the data from the last 72 hours shows that spot volume has remained relatively mute while the price has drifted higher. This divergence is the first red flag that suggests this move is being driven by derivatives traders rather than genuine accumulation. The reality is that price appreciation without significant volume support is often a precursor to a rapid reversal. We are seeing open interest in the futures market climb aggressively as traders bet on a continued recovery. When open interest rises while spot volume remains flat, it creates a highly fragile market structure that is susceptible to a long squeeze. Essentially, the market is becoming over-leveraged to the upside, which provides the perfect liquidity for large entities to sell into. Here's why this matters for your portfolio strategy right now. If you are buying here thinking the bottom is in, you are essentially providing exit liquidity for the whales who bought much lower and are now looking to offload their risk. We need to examine the behavior of short-term holders versus long-term holders to see the true psychological state of the market. Currently, the realized price for short-term holders sits just above the $62,000 mark. This means that the average recent buyer is still underwater on their position, creating a massive wall of overhead resistance. As price approaches their break-even point, these anxious investors are highly likely to sell in order to get their capital back without a loss. This creates a natural suppression on the price that makes it incredibly difficult for Bitcoin to break out without a massive catalyst. I want to draw your attention to the 30-day moving average of exchange inflows. We have observed a noticeable uptick in Bitcoin moving from cold storage wallets onto major exchanges over the last week. Historically, when whales move assets onto exchanges, it is not to stake them or to admire the user interface. It is almost exclusively to prepare for a sale or to use the coins as collateral for hedging strategies. The last time we saw exchange inflows of this magnitude was just before the significant correction we experienced in late 2021. Ignoring this signal is a luxury that serious investors cannot afford. The smart money is positioning itself defensively, while the retail crowd is aggressively chasing green candles on the hourly charts. If this level of detailed data analysis is helping you see through the noise and stay ahead of the crowd, feel free to join our inner circle by subscribing for more strategic updates. Now, let us shift our focus to the macroeconomic environment, which acts as the gravity for all risk assets. While many crypto enthusiasts like to believe that Bitcoin is decoupled from traditional finance, the correlation data tells a different story. The bond yields in the United States are creeping higher again, putting pressure on risk-on assets across the board. When risk-free rates rise, the incentive to hold volatile assets like Bitcoin diminishes for large institutional allocators. We are seeing a tightening of global liquidity, which is the fuel that typically powers sustained crypto bull runs. Without a fresh injection of liquidity from central banks, it is mathematically difficult for the total market capitalization of the crypto sector to expand significantly. This liquidity crunch is why we are seeing these choppy, range-bound movements rather than a clean parabolic run. The market is currently starving for new capital, but instead it is just recycling existing capital between different altcoins and Bitcoin. This game of musical chairs usually ends when the music stops and everyone realizes there is no new money entering the system. Another critical metric we need to analyze is the funding rate across major perpetual swap exchanges. For the first time in weeks, funding rates have turned positive, meaning that long traders are paying short traders to keep their positions open. While positive funding is normal in a bull market, positive funding during a weak recovery is a sign of complacency. It indicates that the crowd is leaning too heavily to one side of the boat. Market makers are in the business of maximum pain. And right now, the path of maximum pain is a sharp move to the downside to liquidate these late longs. We saw a very similar setup occur in May of 2021, where a relief rally to $40,000 convinced everyone the worst was over. That rally was immediately followed by a 50% drawdown that caught the majority of the market off guard. History does not always repeat exactly, but it often rhymes. And the current rhyme scheme is incredibly bearish in the short term. The technical indicators on the weekly time frame are also flashing signals that we are losing momentum. The relative strength index on the weekly chart has failed to break back into bullish territory, despite the recent price increase. This creates a bearish divergence where the price is making higher highs on the lower time frames, but the momentum oscillators are making lower highs. Technical analysts view this as a classic sign of exhaustion. It suggests that the buyers are running out of ammunition and the sellers are slowly regaining control of the narrative. Furthermore, we are currently trading below the 21-week exponential moving average. In a true bull market, this moving average acts as a dynamic support level that propels price higher. Right now, it is acting as dynamic resistance, capping every attempt at a rally. Until we see a weekly close decisively above this level, any upward movement must be treated as a counter-trend rally within a broader corrective structure. The reality is that bear markets and deep corrections are designed to trick you into losing your position before the real move happens. They do this by creating hope, crushing it, creating hope again, and then crushing it again until you are emotionally exhausted. This current bounce to $60,000 fits the profile of a hope generation phase perfectly. It is just high enough to make you feel like you are missing out, but not strong enough to confirm a trend change. If you look at the order book depth, you will see that the bid support below $58,000 is surprisingly thin. This means that if we do get a sell-off, there is very little friction to stop the price from cascading down to the mid-$50,000 range. This air pocket below the current price is a structural weakness that algorithmic trading bots will exploit if the trend turns. We are also seeing a decline in the number of active addresses on the Bitcoin network. Network activity is a fundamental proxy for demand and utility. When price goes up but network activity goes down, it is a divergence that historically resolves to the downside. It implies that the price is being propped up by speculation rather than organic usage and adoption. If you value this kind of unfiltered, data-first approach to navigating these treacherous markets, consider checking the description to join our community, where we share real-time alerts. So, what is the playbook for navigating this potential trap? The most prudent strategy right now is patience and capital preservation. The risk-to-reward ratio for entering new long positions at this specific level is extremely poor. You are buying into resistance with declining volume and bearish on-chain signals. The professional play is to wait for confirmation. Confirmation would look like a daily candle close above $64,000 with a significant increase in volume. If that happens, it invalidates the bear trap thesis and offers a safer entry point, even if it is at a slightly higher price. Remember that missing the first 10% of a move is better than catching the last 10% before a crash. Alternatively, if you are looking to accumulate for the long term, you should be setting your limit orders much lower. Look at the high volume nodes around $52,000 and $48,000. These are the levels where institutional demand has historically stepped in to defend the asset. By placing your bids there, you are aligning yourself with the whales rather than the reactive retail crowd. Do not let the fear of missing out dictate your financial decisions during a period of low liquidity. The market is designed to transfer wealth from the impatient to the patient. Right now, the market is testing your discipline. It is tempting you to chase a green candle that lacks substance. Stand firm, trust the data, and do not get swept up in the narrative that everything is going to the moon in a straight line. The recovery from $60,000 is statistically more likely to be a distribution event than an accumulation event. Protect your capital so that you have dry powder ready for when the real opportunity presents itself. This analysis is based on probabilities and historical data patterns, not certainties. Please remember that I am a strategist providing a market perspective, and this content is for educational purposes only. This is not financial advice, and you should always conduct your own due diligence and consult with a certified financial advisor before making any investment decisions. Stay sharp, watch the volume, and do not fall for the fake out.